Hello, everyone. Thank you very much for joining us today on a panel discussion on the topic of are carbon credits the next billion-dollar insurance market? We're very fortunate to have a brilliant panel who'll be speaking to us on their views on this important part of the insurance market and the carbon market more generally. But firstly, I'd like to just briefly tell you a little bit about this report that we have put together alongside Kita. When you think about how insurance can support the decarbonisation needed to hit our national targets, we normally think about some of the big renewables, wind, hydroelectric, and solar. But as the decade progresses, ensuring carbon markets will, in the view of Kita and ourselves at Oxbow Partners, join this elite club of commanding over $1 billion in premium by 2030. And it really will matter. Carbon markets are used to manage and reduce emissions from these big industries and drive capital towards carbon credits. And today we're going to be touching on these very topics. But firstly, I'd like to also thank those people who have supported and contributed to this report that we've put together. Firstly, the interviewees. Natalia Mudrik from Aon, Natalie Tong from AXXL, George Beattie from CFC, Hayley Maynard and Tom Graham from Chaucer, Olivia Brindle and Richard Rudden from Fidelis, Charlie Paul from Howden, and Steve Forrest and Ryan Bond from Marsh. I'd also like to thank those who have provided case studies from Arbol, AXXL, Carbon Pool, Descartes Underwriting, Kita, Howden, Oka, the Carbon Insurance Company, and Wheatishaw. We've had really great people contribute to this report and give us their expertise and their views on the importance of the carbon market. And we're very fortunate to have this panel together. And before we go further, I'd like to introduce James, who's the head of insurance at Kita, who helped co-author this report with us.
Thanks, Mcdad. Hi, everyone. Great to be here and pleased to be releasing this report. As Mcdad said, we think there's just tremendous opportunity in this space in the carbon markets. And we really think that now is the time for the entire insurance market to embrace it. The carbon markets are looking for leadership from the insurance industry. We know risk well. It's our core bread and butter. And I think we can have a massive role to play in helping de-risking the financing and helping the sector to scale. And I'd just like to echo Mcdad's thanks to everyone who contributed to the report. And I just wanted to give a special shout out to Ailish O'Keefe, who is our carbon markets analyst and partnerships analyst, who's just absolutely fundamental in bringing this together. And she has a weekly LinkedIn carbon recap that is worth a look. It's literally a full-time job just keeping track of what's going on in the carbon markets. And with Ailish and the rest of the Kita team, they do a great job in helping simplify things.
Thank you very much. And I'd like to echo those thanks to Ailish, who's been instrumental in putting this report together. We're now going to have brief introductions from everyone on the panel. I should have started with myself. I head up the sustainability practice at Oxbow Partners, and we're a management consultancy, and we specialize in insurance. And what we've been looking at is the range of different activities that insurers are looking and reinsurers are looking at when it comes to sustainability, all the way from understanding their disclosures and their strategy when it comes to ESG and sustainability, all the way into new products and new opportunities, including the carbon markets. And now it would be great to hear from the rest of the panel. Just a brief introduction. Ronan Carr, the lead analytical officer at BeZero Carbon, Marta Krupinska, the CEO and co-founder at Curate, and Adrian Rimmer, the Director of Sustainable Finance at the London Stock Exchange Group. If we can go through, start with Ronan.
Thanks, Mcdad. Hi, yeah, I'm Ronan from BeZero Carbon. BeZero is a carbon ratings agency, so we provide ratings on the quality and integrity of carbon credits and risk analytics for the wider carbon market, looking at the full value chain from pre-issued credits all the way to fully issued credits.
Perfect. And Marta.
Thanks, everyone. Delighted to be here. I'm Marta, the co-founder and CEO of Curate. We are a market maker for carbon removals, meaning we build portfolios of carbon removal from across the technological spectrum, nature, engineered, and hybrid, and sell that onto clients in sectors like aviation, FMCG, built environment, or major events. We're based in London, backed by Google Ventures and others, and very much in the game to unlock more capital for carbon removal, both on the revenue side and the financing side. So very excited about insurance and looking forward to today's discussion.
And Adrian.
Hi everyone, I'm Adrian Rimmer. Within London Stock Exchange Group, we have a number of different areas looking across the carbon markets and building a value proposition across there. I'm leading the work across that piece as part of what I do. Within our capital markets group, we have a designation for funds and companies that are looking to raise capital and deploy that at scale into carbon yielding assets. We have a 10-strong carbon research team that's been around for about 15 years, and we're building a number of other areas of activity that will unlock some of the barriers to the market, which we'll talk about in due course.
Brilliant. Thank you so much for everyone for sharing your introduction. What we're going to do in this panel discussion is cover three main areas. We'll start off with an overview of the carbon markets, and we'll come to everyone on the panel. We'll then move on to the role of insurance in the carbon markets. And then finally, we'll touch on the opportunity and the way forward for carbon insurance. Everyone in the audience, please feel free to raise any questions you might have in the Q&A box. And what we will do is we'll try and highlight those questions, and as we go along where we can, incorporate them in the discussions that we're having, and if we do have time, touch on them specifically at the end. So now we'd like to start with the first area, which is the overview and introduction to the carbon markets. What are the purpose of carbon markets, and let's talk about the diversity of it and the role of individual bits to it. So let's start with Adrian. What do you see as the purpose of carbon markets as a whole?
Thank you. I think the most fundamental point here is carbon markets are a financing tool. They're a mechanism of delivering finance into carbon mitigation and removal activities that wouldn't otherwise take place, typically because they may be economically unviable. So it's creating an income stream, a revenue stream associated with removing carbon from the atmosphere or avoiding its emissions into the atmosphere that makes more of these types of activity possible. I think it's also important to start, because often and in this case, we'll be talking about the voluntary carbon market quite a lot. It began life as a compliance market. So there are two flavors of carbon. There's a compliance regulated market, and then there's a voluntary market for those companies that don't have a regulatory requirement. But the VCM itself was born of the Kyoto Protocol and of a UN structured regulatory scheme associated with that, the UN Clean Development Mechanism. And that mechanism was designed with two types of country in mind. Countries that were developed and needed to finance climate action in developing parts of the world. So you had Annex 1 and Annex 2 countries covering those two areas. And the idea was that by using a financing tool like carbon credits, overseen by the UN, you would create a mechanism by which countries like the UK could fund climate action in countries like Uganda. And by buying carbon credits from activities that are undertaken by the private sector. So as a way of crowding in private sector capital on the basis of an internationally traded market primarily between countries. That was then incorporated within emissions trading schemes such as the EU ETS. And then as that system went into a decline period, if you like, as the Kyoto Protocol and the agreements around that were seen as not strong enough to really drive climate action, as we were in the kind of period before the Paris Agreement, we saw that approach was adopted by companies who wanted to take climate action, wanted to do so in a robust way, and therefore utilize the same processes. Now, I used to run the Gold Standard, which is one of the main standards bodies in this area. That was born of the civil society desire to say, what does a good carbon credit look like? How do we know it's additional, as in it wouldn't have taken place, or the activity wouldn't have taken place anyway? How do we know it's going to drive development, which is core part of the clean development mechanism? And so initially that started life as a labeling scheme for compliance credits under the UN. And as that market evolved into one that actually the major part of the buy side was voluntary, not unregulated buyers, if you like, the Gold Standard and others like Vera were established crediting mechanisms of their own to deal with that demand and the desire for innovation in this space. So it's a financing tool. It's born of a compliance mechanism. And I think where we're seeing now, for the last few years, it's been very voluntary. We're now starting to see a convergence with compliance schemes. And that's really where it gets really exciting, because it's convergence of regulatory and voluntary, then back into compliance, I think is where we see scale in the market.
Adrian, can you just touch on why do you think the voluntary carbon market hasn't taken off in the way it could have?
Simplistically, it's voluntary. No one has to do this. And for as long as it's voluntary, then it will never reach the scale of the compliance market where bodies are obliged to buy credits or permits, will scale. The other aspect to it is, as a result of that, that lack of an underlying core market of mandated buyers, we've seen an oversupply in the market as what would have historically been philanthropically driven projects in many cases seek private finance through the voluntary markets. So there's been an oversupply problems from time to time. And then the question becomes, who is the regulator? So Gold Standard, Verra, and others have taken that role. But there is a need to see how to scale a market like that. You're going to need investment grade infrastructure, shall we say. And that's what's coming to the market now.
But do you think that the potential is quite large? You said that it needs to be mandated for it to take off, but do you think it might take off anyway if these standards, for example, get stronger and some of these challenges get overcome? Are you optimistic?
Absolutely. No. I've been optimistic in this market for many years. I think the reality is we know there is a huge gap between where we are on the path to net zero and where we need to be. That path can really only be addressed, or a gap can only be addressed by voluntary action right now, because policies are not taking us where we need to get to. So it's incumbent on all companies that they examine where they are in terms of their transition pathway, that they're reducing emissions as much as they can, and then they compensate for those emissions that they are emitting and can't help but emit as they move on the path towards net zero. So I think that's where the opportunity lies here. In order for them to be confident in doing that, they need, as I mentioned, investment grade infrastructure and services around this. Insurance is a really important part of that process, as we'll talk about today. Similarly, the financial markets infrastructure around investment. So in our case, we looked at the success of London as a financing hub for green infrastructure. We looked at the way that that's been delivered primarily through listed funds, which are very good for providing liquid investments into illiquid underlying assets. We said that's quite analogous to the voluntary carbon market. But actually what we need is a set of rules to give investors greater confidence in this new asset class. So we created a set of rules around that, requiring greater transparency, some eligibility criteria, and sat that onto the top of the listing rules, which means it's covered by the market abuse regime. What does that mean? It means there are teeth to the regulations around investments into this space that should drive a flight to quality, which will give those using those carbon credits significantly more confidence. So it's those sorts of approaches coming from all sorts of sectors in the economy that we need to see to make the market grow.
Thanks so much, Adrian. Ronan, let me come to you, and can you talk a bit about some of these projects? You know, the type of projects that are there in the carbon markets and the diversity of carbon markets.
Sure, yeah, thanks, McDad. I mean, obviously, it's key thing to bear in mind is that it is a very heterogeneous and diverse market. You've got dozens of different project types with projects in almost every jurisdiction in the world and hundreds and hundreds of methodologies. So that makes it a very complex market to look at. As an aside, I think one implication.
What do you mean by methodologies there? What do you mean by methodologies?
Yeah, so typically to create a carbon credit, you need to follow an accreditation process. So a standard body like Gold Standard or Verra will have certain standards you have to meet, and then for the particular project type, there'll be a methodology that dictates, what are the rules behind the creation of that credit. And historically there have been, hundreds, let's say, of different methodologies. So there is a real complexity to the market, and that means you need to think about diversification when you want to engage in this market. And I think we need to move away from the picking one project and focusing the narrative of that project to really picking a broad, diversified portfolio of projects. I think the other thing to say is that carbon credits, there is an inherent risk associated with them because, there's always some scientific uncertainty. There's always statistical uncertainty. When we're talking about a carbon credit, it's meant to have achieved 1 ton of CO2 equivalent either avoided or removed from the atmosphere. But that is calculated, using a statistical model, and depending on the project type, depending on the situation, there will always be some uncertainty associated with those calculations. And so we do need to try and find ways to engage with that risk. This is where we believe ratings have a role to play because Ratings are a way to express that kind of distribution of risk, that distribution of outcomes in the market. And this really complements the accreditation process. The accreditation process by its nature creates a credit which, you know, it's either a pass or a fail. It's been created or it hasn't, and it's deemed to be 1 ton. But because we know, you know, outcomes vary, a rating gives you a sense of what's the likelihood that it's actually achieving that ton. So it moves the market towards a language of risk. It acknowledges that, you know, project-specific outcomes can be very different, and it allows the market to therefore, you know, revalue higher quality versus lower quality and move away from the kind of more binary approach that has kind of dominated the market in the past.
Perfect. Thank you so much. Marta, would you like to weigh in on this? On, for example, the role of carbon removal? We're talking about all these different carbon credits. Can you touch on carbon removal in particular?
Yeah, thanks so much. I think it's a really good framing, and perhaps for simplicity, let's think for the benefit of this conversation as the fact that there are 3 types of carbon removal. Sorry, 3 types of carbon credits. See, I'm getting confused. So you've got your carbon protection credits. So this is classically, let's protect the natural carbon sink, say some trees or forests from being cut down. And the second category would be your carbon reduction or avoidance credit. So this is, for instance, cook stoves or moving to solar, also very important. And these 2 have traditionally been understood as offsets. Now we have this new category called carbon removal. And in this particular case, if I emit a ton of carbon and you actively sequester a ton of carbon from the atmosphere, we actually get to 0. The delta is 0, which is that fundamental difference between protection and avoidance credits and here a carbon removal credit. So if any of you on this webinar have looked at the IPCC reports the last few years, IPCC, the Intergovernmental Panel on Climate Change, you will see that the consensus among the scientific community is that whilst we radically need to decarbonize, and that is obviously the focus of so many of our efforts. And also if anybody follows, say, the SBTI, so the Science Based Targets Initiative, they talk about needing to reduce emissions by 90%. The challenge is reduction is not enough anymore. We already left it too late. So in a world where we're desperately trying to hold on to the 1.5 degrees increase from pre-industrial levels when it comes to world temperatures, that is only achievable, if achievable at all, through reduction of carbon emissions and removal on top. And there is an interesting context here, which also many may have heard, the sort of challenge and the fear that if we invest in carbon removal, that is a disincentive to actually reduce emissions. Now, the reality is there is no chance in hell that we'd be able to produce enough carbon removal to just allow ourselves to continue pumping carbon into the atmosphere. And additionally, reductions are almost always going to be significantly cheaper than removal, because the average cost of removal is now, depending on the method, probably sort of circa $200 a ton versus, I believe, $2.3 for the voluntary market sort of offset cost. So in order to keep 1.5 alive, and again, we know that it's within the 1.5 that we can reduce the risk of extreme weather events, and these have a massive financial impact on our real estate, on our assets. I mean, this is really when we're starting to speak the language of money, not just the right thing for the planet or for humanity, in fact, but also the right thing for the entire economy that we've created. Carbon removal is really critical, according to science, to be able to keep that 1.5 alive. And I suppose the thing that we find very important is that we know that there is now a number of methods of carbon removal that are known to man. We can plant new trees, we can farm carbon in soils, we can produce biochar, so you burn biomass in low oxygen environments and you produce this really carbon-rich charcoal. You can speed up weathering of basalt rock, or you can build these sky hoovers that suck in air and chemically or physically separate carbon and put it deep into geological storage forever. We know that there are all of these different methods. The challenge is not a single one scales to the 10 gigatons that is needed by 2050 that's going to help us stay below 1.5. So the market is really new. All of these methods are materially different in terms of what it takes to remove carbon, how long it takes, how long it stays down, how much it costs to produce this. But we need to be investing in all of these methods in the round, because we're already running out of time to hit the 10 gigatons by 2050. So critical methods, lots of risk, but massive opportunity, in fact, for humanity to and the economy to continue existing and operating as we know it, and a massive market that will be created off the back of it.
Perfect. Thank you so much, Marta. I think that moves us perfectly onto the next bit of the webinar, where we've now looked at the overview. We understand what the carbon markets are all about, the diversity within them, and the importance of thinking about all the different types of carbon market, including carbon removals. Now, I guess we want to move on to the role of insurance. Well, what's the point of insurance in all of this space? And I'd like to bring James in here to talk a little bit about what we covered in the report, and a brief discussion on the role of insurance and the products already out there in the market.
Sure, thanks, Migdad, and thanks, Marta. I haven't heard Sky Hoover before, but that gave me a chuckle, so I'm going to use that one going forward. I realized I didn't introduce Kita at the start, so I'll just quickly recap that Kita, we insure carbon. We build insurance products to de-risk high-quality carbon projects like Ronan and Marta were saying. We're a Lloyd's of London cover holder backed by Chaucer, Munich Re, and RenRe, and we're super happy to play in this space. So just big picture, why insurance? The role of insurance really is to assess, price, and then transfer risk, and then that can help enable market participants to actually take the risks, and the insurance can help convert that uncertainty around what the future loss might be into the certainty of an insurance premium upfront, and then protect against that downside risk. So it has a key role to play in any market. As regards to the carbon markets, as Adrian was saying, this report focuses on the voluntary market, but there have been the CDM mechanism and then the compliance markets for some time, and insurance is not new there. And actually a firm called Parhelion in the UK were the original pioneers in that space and built coverage for invalidation of Californian cap and trade credit, which was great to see. And then meanwhile, since we're seeing the voluntary market scale up, now new entrants such as Kita, as well as existing brokers, insurers and reinsurers are looking to explore this space, and each of them add a different perspective, looking at it from a different angle, which is great to see, and which is what we need. When we think of the insurance products for the carbon markets, there's sort of two dimensions from my sort of insurance hat. There are existing insurance products which can be applied for a new market, and then there are new risks that need brand new insurance products. So I think for the existing coverages, that's where the insurance industry is really well placed. It just needs to appreciate the new context, but it's pretty doable. And when we look at, say, property risk for the new Sky Hoovers, then it's quite easy for an insurer to understand. There's the physical, the construction risks, the nat cat risks. There's the liability risks of the operation. There's D&O. There's marine cargo, construction. All these things that are existing market players will be comfortable with. They just need to know the context, and also that there's an opportunity out there that they can go to target. And we factored those in when we accounted for the overall insurance opportunity as well in our predictions. But the new coverages, I think that's where it's quite interesting, and that's we tried to highlight a few of those in the report. It's not an exhaustive list, but when we think about these risks, we think it's useful to think about it in the context of the life cycle of a carbon credit. And I won't go into detail, but we mentioned in the report. But there's sort of three key phases in that sort of life cycle. There's a concept phase, an execution phase, and a retirement phase. The concept is pre-validation. So your question around what are the methodologies, it's getting a project validated against one of those methodologies. It's a sort of scoping, securing financing, getting the green light to proceed. The execution phase is the actual doing, go out and capture the carbon. And that really covers a very broad basket of risks. We look at it from a avoidable risk, unavoidable risk, and a carbon market risk standpoint. So avoidable risks would be insolvency, negligence, credit risks. Unavoidable risks would be your physical risks, so your traditional insurance, nat cat, fire, flood, pest, drought, disease type risks. And then the carbon risks is a nuance here, would be around sort of invalidation or downgrade of those credits before they come to market or once they've come to market. And then the retirement is post-issuance. Again, invalidation can be a risk, but also reversal. So that's the risk that the underlying project that captured the carbon has had a loss such that the carbon has escaped. So a forest burns down or carbon injected underground has some leaks. So, and then throughout all these stages, there's reputational risk, political risks, market price risks, and other risks as well. But we think those sort of 6 or 7 or so that we highlighted in the report are the main themes. We've given an example of these in the report, and we're working on a few more ourselves. But I'll pause there, but just to leave with the thought that we're very good at pricing and assessing risk. The challenge is to overcome the need for all the data that we need to get comfortable with that in a nascent market. But we think that by embracing the new technology, using proxy data sets and good old-fashioned risk selection and syndication across the market, which is something the market already does well, that there's the scope for growth. And by starting with some proof of concepts and building up from there, there's tremendous, or as Ailish would say, tremendous opportunity. So I'll pause there. But
tremendously well done. Well, nice. Let's Martin, maybe let's come to you. We've talked about all these different insurances and the different risks that need to be covered. Can we talk about how that works in the carbon removal space? And yeah, your thoughts on the role of insurance there.
Yeah, thanks, Big Dad. I have to say, I think tremendous might be beating Sky Hoovers. So I wonder if anybody else is going to one-up us now. Maybe Adrian and Ronan will have something to, in the conversation. So yes, I mean, obviously, I think I would like to root it in the market opportunity again. So if we're looking at 10 gigatons a year by 2050, if we times that by, even if we reduce the average cost to $100, we're talking about a $1 trillion plus industry. And there is a report published by McKinsey in December last year that sort of talks about that opportunity. Now, we need to build an industry that's bigger than anything we've built before and faster than what we've built before. If any of us remember how renewable energy or solar was discussed years ago, it's never going to happen. It's never going to get cheaper. It's not going to move fast enough. A lot of these arguments were made because well, it felt like the reduction of cost of capital and the appetite for purchases would not grow as fast as it did. The reason why it did was because we were able to reduce the risks, reduce the cost of capital, and in fact drive it to a place where it's not only better for the planet, but actually more economically viable. So we very much see a massive role for insurance to help drive capital and drive demand. Now, when I think about what we do at Curate, sort of we were born out of the frustration that some buyers are seeing both the benefit and, well, the incoming imperative. This is very much going to be driven by the compliance market in the coming years to start buying carbon removal. However, it can be quite tricky to understand what quality looks like, especially when you don't have massive buying teams. So our first product to market was portfolios of carbon removal. It's the most easy and straightforward de-risking strategy when you just take a number of projects from the global north, global south, carbon that's already removed, so exposed, and carbon removed in the future, ex ante, and all of the different methods, and you sort of de-risk it in that way. You also achieve a lower price point with additional biodiversity and social co-benefits. That's great. Now, the reason why we did that is also because we're hoping to stimulate demand. Now, the challenge is, again, we talked about a massive need from the market to be developing these technologies. But currently, as Adrian said, it's a voluntary market. There is no reason to necessarily buy today. So we just need to be making it easier. And we also need to be making it commercially viable, including for capital providers to come in and provide capital. One of the things that we've done to try and sort of make a case for sort of coming in and doing these early deals, we actually brokered a transaction between British Airways and Standard Chartered Bank in order to provide capital to an enhanced rock weathering provider, Undo. Now, I cannot tell you the number of times I've been asked, is there insurance? Where can there be insurance? We would be able to do this transaction 10 times faster and cheaper and better if there was insurance. And I can already tell you that this was with one of the most reputable providers in the world. And there are probably 5 or 7 today that are even qualifying for a transaction of this kind. And if we want to be bringing all of these different methods of carbon removal online, we will need to be able to de-risk these transactions for everyone involved. So I think what is very, very key for us is it's fantastic to see the likes of Kita now understanding the different types of risks per carbon removal method. What we see is there is really a desperate need to get to a place where every carbon removal method could be insured. Again, to the point of not picking winners. In a world where we would only be able to insure a couple, the other ones are going to be left behind. And then again, sort of from from the market perspective at large, that would be very disadvantageous. And at the same time, what we believe is going to happen is the moment that the risk is reduced, we will be able to get more buyers buying. A great example is, so Frontier Fund is a coalition of buyers from some of the world's biggest tech companies, so sort of Stripe, Shopify, Meta, Alphabet. That's $1.2 billion that is currently going into removals, and that is willing to pay between $400 and $600 for certain methods of carbon removed. Now, in order to get other sectors, especially say hard to abate, we're going to have to drive that price massively down, and we're going to have to also reduce the risk. And especially when it comes to credits that are removed in the future, so the so-called ex-ante credits, which is currently about 99% of the market. So in essence, what happens is a buyer has to come in, commit to buying. In an ideal scenario, they would front the capital, but would they have the balance sheet to do that? If not, somebody else should be financing that transaction without an understanding of risk that's going to happen. So I think especially when it comes to the development of ex-ante credits, I think, again, insurance can play an absolutely key part.
Perfect. That leads us very nicely on to Ronan. Would you like to talk about those ex-ante credits and the need for insurance in this space?
Yeah, absolutely. Thanks. So I think, insurance solutions already could achieve a lot if we think about issued credits. One of the risks with nature-based credits particularly is that the CO2 that you've removed or avoided could be reversed in the event of a natural catastrophe or a human disturbance. And the registries operate what they call risk buffers to mitigate against that risk. But these risk buffers can be quite inefficient or can be quite blunt tools, and kind of professional insurance solutions could potentially really make that a much more efficient process. But I think this kind of the growth of ex-ante credits, as Marta refers to them, as we do too, I think is a really massive opportunity for insurance. Not just in removals, but across the whole of the carbon markets. Actually, a lot of the activity is moving upstream to the early stages. And some estimates say for every dollar being spent on issued credits, $4 or more are being invested in early stage carbon projects. Now that means it also introduces some new risks, right? So you're still worried about the future quality and carbon efficacy of the credits that are expected to be delivered in the future, whether you're the investor, whether you're a pre-purchaser or an off-taker. But in addition, you're also worried that those credits will ever be delivered to you, right? What's the risk of the project failing or you not receiving those credits in the future? And so we've developed a complementary ratings product to cater to this market, which we call ex-ante ratings. But essentially, it's a rating that can be assigned at any point pre-issuance from project design stage onwards. And it looks at the same risk factors that go into our ex-post ratings, with the addition of an analysis of project execution risk or the risk of project failure. And this is an analysis of some of the risks that James talked about political risk, about regulatory risk, about not getting validated, about just the technical risk associated with the project, etc. But insurance obviously can play a massive role here too, to manage and mitigate and reallocate these risks and help to draw in other pools of capital. Because we clearly need a lot of capital to scale this market. And I think I personally see ratings, but also insurance forming a major part of the financial model to help scale these markets, as people look for new ways to do DD, price the cost of capital in these projects and benchmark these future projects against what they know in the market today.
Perfect. Thank you so much. Adrian, would you like to chip in? What needs to happen for the market to scale?
Sure. Well, a number of things. We talked earlier about the fact that this is a voluntary market right now, but we're already seeing that convergence with the creation of new regulated markets and policy-driven markets, if you like, where there may be, take the example of South Africa, a carbon tax, but where a carbon credit produced domestically can be used in place of paying that tax. So this as I would put it, sort of archipelago of markets where you're going to have different geographic regions using underlying methodologies that are the same. Essentially, the same production of carbon credits is taking place, but in certain markets, certain types will have a compliance value. So you might get something that's eligible in South Africa for the carbon tax because it's produced domestically. It might be eligible in a certain other emissions trading scheme because it comes from the African continent, and those are seen as driving investment. It may also have value, therefore, to a voluntary market buyer. So what does that mean? It means that's a really complicated set of activities taking place. Regulation is going to be required to really think about how those markets can interact, and financial markets are really good at helping those financial flows between these different types of markets, looking at arbitrage opportunities and how they can be used to drive capital efficiently. So there's a real need for a market that has significant potential to scale to follow what other financial markets, both commodity markets and financial instrument markets, have, which is a regulatory underpinning and proper infrastructure, data, ratings, insurance we've talked about. Capital markets governance is another area. So I think that we need to see all of those pieces come into play. If I think about the work that we did in creating the VCM designation, that will allow, and has allowed, funds to be listed that will create carbon credits. Our innovation around that was to pay dividends in carbon credits, so they can pay a dividend in specie of carbon as well as or instead of a financial dividend. Now, if I was listing one of those and bringing one to market, then I would want to see to show my investors that I de-risk that. Insurance as part of that makes total sense, and we see that in other infrastructure assets that are brought to that. I'd want to get a ex-ante rating because I want to be able to demonstrate that I have a credible chance of delivering what I'm going to do. And then I want the comfort of the public markets framework and the market abuse regime in the UK to be able to know that what I was being told or what I was telling my investors, they could have confidence was correct. So all of these different things need to play a part and align together to be able to make this market scale and work efficiently. And I think if we can achieve that, we'll build the confidence that will mean, as well as a growing regulatory buy side, we'll see confidence from the corporates that still sit outside of those areas to be able to come into the market at scale.
Adrian, just to pick up on that, am I being simplistic if I were to say, look, we want to build a sophisticated market. There's going to be literally tens of billions, if not hundreds of billions of investment into this space. If you're having hundreds of billions of investment and you've got a sophisticated investor making that investment, in what universe are they not going to buy insurance?
Well, I mean, I think it's a reasonable comment, and it's why, to Marta's point earlier, the feedback was if we had insurance, we could do this an awful lot faster because it removes or it delegates, if you like, the due diligence or aspects of the due diligence that are required, because I can have comfort that somebody else has done that and is managing that risk on my behalf.
Perfect. That moves us really well onto the next and the final area that we want to touch on, which is the opportunity ahead of us. We've talked about the carbon markets generally. We've talked about the role of insurance, and now we're looking at the opportunity for carbon insurance in particular. James, would you like to outline the overall addressable market and what we've concluded in the report?
Yeah, for sure. And I'll try to be quick, because I know we want to get time for some questions. The opportunity is massive. We think it's akin to the next cyber. Cyber, I think, is about a $15 to $20 billion market with potential for getting to 23 billion in 2025. Cyber's kind of just appeared in the last 10 years. We think carbon is the same. 10 years ago, cyber was the new D&O. So I think there's sort of merit. History doesn't repeat, but it rhymes. Just to get to how we got to those figures, obviously we're taking into account the leading reports from the banks and the consultancies as what the top line growth was. We then sort of took a top-down approach, feeding that into our own forecasts. Obviously, there's a range. I think the general trend is very bullish, from quite bullish to extremely bullish. And then what we took was modeling different scenarios to kind of low, medium, high, what we think the insurance opportunity is against that in terms of insurance penetration, i.e. the number of deals and transactions that would have insurance on them, as well as the insurance rates that would be applied. And we triangulated with sort of industry leaders from the insurance sector to kind of build out a conservative range. So we're very bullish on this. We wouldn't be insurers if we weren't cautious, and we do have a few caveats that I think we've alluded to already. We did exclude the impact of regulation. Like Adrian says, that could be a real sort of demand driver in due course. Excluded the compliance markets, but as they converge, there'll be more sort of cross-pollination of demand and risks there. And then we also excluded the additional investments, like Ronan was saying, sort of pre-project basis. These are sort of top down based on the sort of annual credits that will be issued and traded at points in the future, but it's not baking in that additional investment, which could be a 3 to 5x multiple as well. So and then just in terms of the insurance stats, we assume there's going to be low penetration of insurance products into SART. We think pricing will be high because there's a factor of conservatism built into risk models, but that pricing will reduce in later years as loss trends emerge. The data models become more accurate, and everyone becomes more comfortable with the risk, and the insurance penetration will conversely rise. So that's how we got to these. There are ranges though, so but anything is possible.
So we're looking at $1 billion in premium by 2030, a huge potential, and likely to grow many times that by 2040 and 2050. The next cyber, but what's going to make that happen? So Ronan, can we talk about data? We've touched on this being one of the key challenges that is preventing this huge opportunity. Would you like to touch on the challenge of data and the surrounding risk management mechanisms?
Yeah, I mean, look, I think any asset class or any insurance market, relies on an ecosystem of risk management tools and information tools, and we haven't had many of those in carbon markets historically, but we're now starting to see them emerge with ratings, with data analytics providers, insurance providers. So I think that's the first point to say. Secondly, I think the backdrop in carbon markets is, I think, looking more and more constructive for insurance, particularly from the perspective that the market is becoming more efficient from a price perspective. 2 years ago, there was actually very little link between the quality, the kind of carbon efficacy of a credit, and the price you paid for it. And that's really starting to change. So in the second half of 2023, credits that are rated single A or higher on the BeZero rating scale, we're commanding a price 3 times that of credits rated lower down the scale. So the incentive structure in the market is changing, moving away from a market that rewarded, issuing higher volumes to one that rewards quality and therefore value. And that makes the business case for insurance, I think, much clearer, right? If you know that higher quality is rewarded, then you're much more willing to pay for it. You're right that data is absolutely key. I think there is an opportunity here for ratings and analytics providers to collaborate with the insurance industry to create that data. We've rated over 380 projects ex post, and so we've looked at a lot of data, but we're also generating our own data, our own understanding of what drives risk in the market. And so there's definitely an opportunity to collaborate there and backfill in some way the loss data and the risk metrics that maybe haven't existed historically. Ultimately, I think that collaboration can evolve, because you look at other markets, then insurance and ratings do interact. Think about credit enhancement and fixed income, with the use of bond insurance. I think potentially ratings could be a criteria for insurance to kick in. So there's lots of ways that we could certainly play our part in working together with the emergence of carbon insurance.
Perfect. And do you think there needs to be some sort of regulation or oversight of the standards of the ratings that are there? Like, does there need to be something more over and above what we've already seen in terms of the standards that have been set up?
I mean, we've tried to set our company up so that we operate with a financial market type standards of governance and operating procedures on the basis that regulation may come one day. We already see the likes of the CFTC in the US looking at and IOSCO and other securities regulators looking at regulation. So I think it's quite likely to happen in some form. And the industry is also looking at its own initiatives to improve kind of structures like the core carbon principles and ICBCM. So I think in various forms, regulation or quasi regulation will come, and certainly if we move towards gradual integration of what we call voluntary markets into compliance, and we see this already. I think Adrian mentioned South Africa, but also Singapore and other markets are going down this road. Then obviously the kind of regulatory burden would increase. So yeah, we would expect it to be likely form part of the picture as time goes on.
Perfect, and that moves us nicely on to Adrian. Can you touch on that? We've talked about this huge opportunity. We've talked about data being a challenge and risk management solution mechanisms being one challenge. One of the other challenges or potential opportunities is that convergence of the compliance and voluntary market. And you touched on this earlier. That could scale the opportunity manyfold. Do you want to expand on that further?
Yeah, I think as we've I think it's been highlighted in different ways through the discussion we've had so far. We've got different. The source of credits, the types of activity that generate credits, whether they be avoidance or removal credits, are different. Hundreds of different project types that can deliver these carbon credits. We have a problem in this market that is driven by that lack of homogeneity, right? So, and the ratings agency is looking to address that through trying to give you a sense of how likely is this ton of carbon a whole ton. I think as we start to get more sophisticated at looking at that, we can start looking at weightings associated with different types. So I think one of the interesting areas for me is where if there's a level of uncertainty around REDD+ projects, for example, so those are the forest conservation credits, then if I think that's, versus say a technology removal that can be, 99% certain that the ton is the ton, but in a REDD+ project, I might have an uncertainty of, I don't know, 5 to 10 times, depending on the type of project and location, etc. Well, if I can get to a stage where between the ratings agencies and the risk management that's provided by the insurance sector to say, well, actually, if I buy 5 or 10 credits from a REDD+ project, and that's considered to be equivalent in the eyes of a regulator or other to a whole ton. So I'm perhaps probably overstating the risk here. But if I buy a set defined number of credits, and I can record that as a definite ton, then we start to get some sort of equivalence that takes place in the market, which is incredibly helpful, because what we need to see here is, I think Martha said it earlier, is finance flowing into all forms of decarbonisation activity worldwide, particularly in the global south, where we want to see a leap, to avoid a high carbon growth path. We're going to need flows of capital in to avoid that. How do we do that? We manage risk. We look at equivalence ratios around the way that these credits are issued, and we start to adapt to that way of thinking. And that way we can, rather than risk to seeing capital flight to certain types of high confidence credits and actually the market failing to address some of the really important areas from a development perspective as well as decarbonisation, we start to create a mechanism by which capital can flow as efficiently as possible, in line with preferences from those buyers, aligned with their supply chain, for example, and that makes the market work a lot more effectively. So I think that will be a really key piece, and it requires all the things we talked about today to make that happen.
Thank you. Martin, moving on from that, let's say we've got this huge opportunity. We can overcome the challenges of data and some of the standards that we've seen, and maybe even the compliance market converges with the voluntary carbon market. I guess the question seems to be, when is this going to accelerate? Not if. How quickly can insurance enter the market and make an impact? And do you want to touch on that?
100%. I'll try and be brief, as I know we want to move on to the Q&A. I mean, I think it's definitely when, not if, but I also think that it's already happening. And if I may be so crude, whoever's on this webinar and working in insurance and doesn't already have a very aggressive strategy as to how they're going to enter this market, I think they're going to be left behind. And I very much operate in a world where sort of startups move faster than large organizations. So, definitely huge nod to Kita, but also the likes of OCAR Carbon Pool. Though on the flip side, I think I can definitely say we've had great experiences with the likes of Howden, for instance. But I feel like it's coming online already. We know that multiple players have insurance available for individual methods. I think we need to be able to price it better. We probably need to figure out some of the solutions, or some of the open questions are, to Adrian's point, fungibility. How can we understand that better? For instance, could we pay out insurance in cash or in credits? Many organizations would prefer to be paid out in credits if they want to make a particular claim. So, for instance, at which point will we get to a level of maturity where we say, oh, if 7 tons of trees defaulted, we can swap it out for 1 ton of enhanced rock weathering, for instance, and when there is consensus in the market. But, well, these are, I think, technicalities. I think we should absolutely be striving to be putting as much of the insurance products online right now. I personally am looking forward to, I believe, correct me if I'm wrong, I believe there has not yet been a default. or a payout. I think something very important is going to happen in the market when that happens, because we just need to become more comfortable with this risk and sort of see that, you know, we are comfortable in it with it in every other parts of the market and the economy. And I suppose, you know, reports like this one and webinars like this one are only helping us come together and all push in the same direction. So yeah, I suppose that's a thanks and a very optimistic view from me.
Can I just come in with a quick thought? We talked about what the insurance sector can bring to this market, and the opportunity for making these markets more efficient, institutionalizing them as with other classes, asset classes, important. I think there's maybe a missing point here, that the insurance sector as a whole should become one of the biggest buyers of carbon credits. It is a macro risk. Climate change is a macro risk. And so a way that can be reduced is by financing climate action, and this is a very efficient way of financing climate action. So whether it's through direct investments as part of its asset management and work, or whether it's through where it has investments in companies, driving them to offset their unavoidable emissions. The incremental effect of every single company in the portfolio offsetting its emissions reduces everyone's macro risk associated with climate change. So I think it's important to note that there's another side to what the insurance sector can bring here, and it's a lot of capital.
Thank you so much. And we do have some time for questions, which I'm very happy about. So maybe I'll take a couple of the questions that come through. The first one is, how can insurance companies start developing their internal carbon insurance business? So maybe James, you can take this one.
Yeah, I mean, simple answer is get the young people involved. I think get early career graduates, and they're super passionate about climate risk. Tell them to go research and present back and say, as like your question, Migdad, why shouldn't I insure this? Why isn't this insured? I bet they'll find very compelling reasons to persuade you why that should be the case. You don't necessarily need to have a dedicated carbon desk, but having some detailed insights and doing some proof of concepts, testing it with live deals, and then building from there, I think that's the way to go. And the London market especially is very good, well set up for that structure. So
perfect. Some people put their hands up. I'm not sure if we can allow them to speak. Let me try. The first one is
Migdad, there was one question which might be worth raising. It was on in which cases is parametric versus indemnity insurance most appropriate from a buyer's perspective. So that's getting a little bit more into the technical side of insurance for the carbon folks, but I think worth addressing. So indemnity is just paying out a loss due to covered risks. Parametric is paying out a fixed amount of cash if certain defined triggers, parameters occur. So the example would be if there's a hurricane of X strength in this location, then there's a payout of X dollars. My personal view on parametric is it has really good application at sort of two ends of the spectrum, either for very sophisticated buyers who use it as a complement to their existing insurance coverages, or it can work at the sort of micro element when you can bake it into a platform, example being Central American farmers that might have parametric insurance for above average or below average rainfall. But the advantage in both cases is they know that for a certain element of coverage, there's an immediate, for almost next day payout, but it doesn't cover everything. So I think there's definitely a use case, and it's very complementary to indemnity insurance in the carbon space.
perfect. I'm going to try and ask a couple of people to if they can ask their question. Mark Smith.
Can you hear me?
We can.
Great. Thank you so much for organizing this panel. I'm starting a early stage venture looking at sort of the farm as a carbon factory, and one of the things that we're looking at in particular is biochar, and then also very interested in enhanced rock weathering, and just kind of wanted to get a sense of, from the view of the experts on this panel, are those at a point, particularly the biochar, where this is a bankable kind of free credit that could be sold to help support the development of the project? Could you give us just some view on in terms of, I know that there's a lot of development that needs to take place in terms of verification schemes, certification, and insurance, obviously, that you've been addressing, but like, what do you think is viable right now to get started in the carbon removal space?
Maybe I can go first, Mikdad. So as a rating agency, we have rated 2 biochar credits already. So if we think about the engineered carbon removal space in general, the vast majority of the supply is in the future. And there's not many credits you can buy to retire today, but biochar is one of the technologies that's more developed. And as I say, we've rated two projects ex post. Both of them achieved a single A rating, so that's a very strong rating in the context of the broader VCM. There are a couple of AA rated projects, but there's no AAA rated projects yet. So I would say biochar is is more advanced in that sense in its development. And we expect to see more projects coming through the pipes as well over the coming months.
I can just add from an insurance perspective, I think biochar and enhanced weathering are both eminently insurable. Biochar feels a lot more like a classic insurance risk because it's a sort of production process from a pyrolysis machine. So you're looking at the classic sort of fire risks. Then there's the additional nuances of what's the supply chain, the feedstock that's available. What's the co-location of the biochar? Is it on a nice standalone low risk location, or is it co-located with a sawmill where there's lots of potentially explosive sawdust in the air? So that it's quite a sort of insurance friendly risk in that sense. ERW is a little more tricky because it's still at a sort of hypothetical position around the modeling of the weathering. So it's less easy to measure, but we think it's something we're comfortable with it now. And I think that the insurance industry will need a little bit more time to digest, but we're very comfortable with it. There's a little bit of an environmental liability risk around that if there's potential for heavy metal sort of leakage and contamination, but something both elements that insurance could get comfortable fairly soon.
Thank you so much, and we'd love to take lots of questions, but unfortunately we have run out of time. Apologies to those who raised their hands and who raised questions who we haven't been able to answer today. But thank you so much to all of you who've attended. We had over 160 people or 180 people, I think, at one stage. So real great interest in this work. And all that is left for me is to thank the panel. Thank you all for sharing your insights, for supporting the work that we're doing, and hopefully everyone will have the opportunity to read this report. So thank you very much, and goodbye.